unfortunately, right now, there are new financial technologies that are being developed that are literally just getting seeded into the overall financial system. And we obviously don't have a lot of knowledge about those. We don't have a lot of experience about them. We really haven't given much thought as to what can go wrong. But it's typically the unknown that comes back to basically bite the regulators.
That was Jim Wigand, who, along with John Bovenzi, one of our co-hosts at Banking Bad, spent a tumultuous week in September 2008 dealing with some of the most complex situations the FDIC has ever dealt with, all occurring at the apex of a credit crisis that was sending shockwaves through the U.S. and global financial system. This is the second of a two-part discussion on the situation that John and Jim found themselves in during that period when it seemed the world was on the brink of a financial meltdown. Jim and John played key roles during that period when they and their teams worked virtually around the clock to deal with the failure and near failure of two of the largest problem banks in U.S. history. We ended our last discussion at the point where a deal had been struck with J.P. Morgan to have virtually all the banking assets and assume both the insured and uninsured deposits at Washington Mutual, all at no cost to the Deposit Insurance Fund. It's important to point out that the transaction was and still is the largest ever failure of an FDIC-insured bank and was accomplished mere days after the failure of Lehman Brothers that had sent financial markets around the world into a tailspin. Notwithstanding those trying circumstances, the deal was, well, from the perspective of the FDIC, an ideal outcome. Quite the day's work, you might think. But the ink had not yet dried on that deal when the FDIC, unexpectedly, received a call warning of the impending failure of Wachovia Bank, then the fourth largest bank in the United States. That call set in motion a series of events that required the resolution team to recharge and refocus on a problem that once again was of a scale beyond anything the FDIC had dealt with to that point. John, quite the week you and Jim had there. Can you take us through what happened after the WAMU deal and how subsequent events unfolded during what must have been an incredibly stressful period?
Before getting into the weekend's events, Jim, could you give us a little background on Wachovia?
Wachovia was the bank holding company itself was the fourth largest bank in the United States. It had a large depository institution, Wachovia Bank, but it also had two thrifts. It had several broker-dealers, one being a retail broker-dealer, and it was really quite a bit more complicated and messy than Washington Mutual, which even though it was a large and the largest thrift at the time, was, with respect to its connections and interrelationships, relatively simple. Wachovia, on the other hand, was much more complicated. But it, as a result of having these mortgage loans that the market was viewing as problematic, which, like I say, initially resulted in the need for the government to intervene with and put into conservatorship Fannie Mae and Freddie Mac, and then what ultimately led to Washington Mutual's demise. The market was basically saying, look, I mean, the next institution that has a lot of these is Wachovia, and we're losing confidence that it's a viable entity as it's currently structured. So, we started thinking about, what could be done, and there was a lot of coordination with teams at the Treasury Department, the Controller of the Currency, and the Federal Reserve with respect to how a transaction could be structured for Wachovia. And Tim Geithner, who was the president of the Federal Reserve Bank of New York, and this was just a perception of ours at the time at the FDIC, was concerned about the viability of Citigroup, a Citibank in particular. And it struck us that there was perhaps some desire to try to kill two birds with one stone, and that is provide some assistance to Wachovia and at the same time assistance to Citigroup. And
you saw the movie Too Big to Fail with the guy playing Geithner moving all the cards around, figuring out which institutions could match with which, and he decided, I guess, that even though Citi might be failing, it would match it with Wachovia, and they may both make it, I guess, is
Yeah, well, there's a certain thought to that, but clearly, if one of the institutions has assistance, I mean, that might be able to prop up another. From my own experience, there was a program at the Federal Savings and Loan Insurance Corporation that basically had that school of thought associated with it. And it was where a somewhat troubled thrift would acquire a very troubled thrift. And it ended up being actually not working out so well.
Yeah. And at the same time, we're running out of bidders. Like we were saying, JP Morgan had just bought Washington Mutual, and
Correct.
So pretty much down to, Wells Fargo, and we thought we had a deal on Saturday, but it fell through. And so we had Wells and Citi, and Sunday, I remember there must have been like 20, 30 FDIC staff in my office, which was right next to the chairman's office. And you were in charge of talking with which one, Wells or Citi? And
Wells.
and I was talking with Citi, trying to figure out the best deal we could get. And every hour I'd go over to the chairman's office and let her and the vice chairman know what the status, and she'd be on the phone with the other agencies who had their own rooms of people. Everybody saying, hurry up and get these bids in. And it was a crazy night.
It was a crazy night and very compressed time frames. And of course, like I said, you're dealing with an institution which was pretty complicated when it gets right down to it because of the multiple depository institutions, the broker-dealer relationships, and there were many other subsidiaries involved too. And I distinctly remember being asked by the chairman as to whether or not Wachovia Bank itself could just be put into resolution. And the answer was basically no, because it had too many tie-ins to its affiliates, and it would be too difficult to predict the outcome as to how all that played out, because you end up with what was then occurring for Lehman Brothers, these multiple competing insolvency proceedings among the various subsidiaries of a financial holding company. And it just wasn't possible to put Wachovia into resolution, Wachovia Bank.
Yeah, at the staff level, we certainly had no intention that it'd be a closed bank transaction like
could not
done with Washington Mutual. It was just too much bigger, more complicated, and the contagion effect it sort of started.
Yeah. So ultimately, what happened is that Wells, and this was, it was kind of interesting. I mean, in the discussions we were having there late Sunday night, it was clear they were hesitant to move forward. Ostensibly, one of the reasons why is they felt they didn't have enough time for due diligence. But as it turned out, they were also looking for a tax opinion from the Internal Revenue Service as to the treatment of certain aspects of a transaction. And until they receive the ruling from the Internal Revenue Service as to how the transaction could be treated, they really didn't want to commit. And that's perfectly understandable because the amount of tax obligations you have has to be factored into the equation as to what you're ultimately willing to pay for an acquisition. And so the Citigroup deal was the one that ultimately was accepted, and we went to the board for that and what was then a systemic risk exception, because we didn't think it was necessarily going to be, the lowest cost deal would actually have been to put Wachovia Bank into resolution. That would have been the least cost transaction because of the outright direct cost to the deposit insurance fund, which would have probably been no cost because there's all these other liabilities with the affiliates and other creditors, bondholders, et cetera, that would absorb loss, but it just wasn't feasible. So that being said, the Citigroup transaction ended up getting, that whole package ended up getting a what's called a systemic risk exception. And that was a determination that was made in the wee hours of the morning Monday.
Yeah, the contrast between the two bids was amazing because, like Wells said, look, FDIC, you cover the first $20 billion in losses, and if there's any losses above that, we'll cover it. So we viewed that as a potential cost to the FDIC of $20 billion. Citi, did the opposite. They said, well, we'll absorb the first $42 billion in losses. But if it goes above that, then FDIC, you cover everything. Now, we didn't believe the losses would come near approaching $42 billion, so we viewed Citicorp's bid as costing the FDIC zero and, much more favorable. I was starting to get used to the city people talking to them on the phone, and when they gave that bid, and they sort of blew it with me, because then they've said, and the added advantage of this bid is what we're doing will make the government look smart. And I took a little offense at the time, but they had a great bid. So,
yeah, no, it was a good bid, and as I indicated, Wells was being prudent, moving forward, and it wasn't surprising, with respect to the bid it produced. But as we know, they got the IRS ruling as to how the tax treatment would play out, and then they actually submitted a bid to the board of Wachovia Holding Company to acquire it in a stock deal, no government assistance, and subsequently made the transaction without any government assistance at all.
From my understanding, the city bid was announced on Monday morning, correct? When did Wells Fargo, what was the time frame between the initial announcement, which, from the city perspective, and then ultimately the Wells Fargo?
Jim, correct me if I'm wrong, but Tuesday morning they got their ruling and put in a bid directly to Wachovia's board. And in City's deal, it said that the shareholders of Wachovia would get roughly $1 a share or something. But now Wells, got a tax ruling that they thought would benefit them by $20 billion. So they gave an offer to Wachovia's board of something like $7 a share, and the board accepted it. Again, I think Tim Geithner was pretty upset with the FDIC because he thought there was a deal, but the city folks had been very slow to sign a term sheet.
Yeah, no, it was a little bit slower than that, John, and that so the deal with Citi was announced on Monday, the 29th, and it was Thursday when Wells submitted the proposal. And I still remember that because I was picking up dinner at a pizza place, and I get a phone call from the chairman saying, Wells I just got a call from Wachovia saying Wells has submitted a proposal which results in no cost, to the FDIC, or no government assistance at all. And that was a Thursday evening, and
at least you didn't have to come back to the office for that one.
Correct. I did not have to go back to the office for that one. But I'll tell you, to some extent, it was really because Citi was dragging its finalization of the details of what had been its bid. And so, here we talked about it, Monday during the day, because actually the FDIC approved the transaction in the wee hours. I think it was like 4:30 a.m. or 6 a.m., but it was very early in the morning on Monday. And so part of Monday, Tuesday, Wednesday, still talking to Citi, about the transaction, and it still hadn't been finalized yet.
Yeah, so they sort of let it slip away from them, and Wells snuck in and sort of took the deal away. We were fine at the FDIC because it was like all of a sudden no cost to us. And so when Citi complained and Geithner complained that, we were backing out of a deal, there was no deal, and we had no role anymore with the deal because it required no FDIC assistance. It was up, to the primary supervisor to approve the transaction.
So just a perspective again on that, maybe just another question, but FDIC is always prefers a private sector transaction. So that's always available at this point in time. I'm just curious as to how Wells Fargo might have thought of the situation when they saw the announcement that Citi had struck a deal with the FDIC to buy the institution. Did that, clearly that didn't distract them. They kept on going.
They got the ruling from the IRS, which they viewed as saving them $20 billion. So they changed their bid by that amount, effectively. So I think they knew they weren't going to get it, over the weekend, but you can't tell for sure.
Yeah, it's a question you really have to ask Wells, Tom.
So we've talked about the transaction, and we didn't bail out Washington Mutual. We were about to bail out Wachovia. When is a bailout appropriate or not appropriate?
Excellent question. And it's one that's going to forever torture the policymakers and decision makers in Washington and every other capital that oversees a banking industry, because the overall economic and financial environment is going to play a key role in that. If there is a time of financial stability and overall economic growth that is, continuing to take place, and one of these large institutions fails as an isolated event due to perhaps a massive fraud or a really bad trade, or which, quite candidly, is pretty improbable, but sometimes these things do happen, then probably a bailout is not going to be necessary. That particularly with the protocols and policies and programs that have been put into place after the global financial crisis of 2008, that large, complex institutions should be able to fail in isolation without causing the implosion of the rest of the financial services sector or the economy. However, and this is where the situation changes, typically those large institutions are stressed when there is economic decline and financial stress in the financial services industry. And as a result, other institutions are also suffering, we'll say maybe credit losses or concerns associated with deposit withdrawals or concerns associated with loans going bad, or the inability to raise funds in the credit markets, or certainly raise additional equity capital. And when that type of situation is prevalent in a country's economy, a bailout is something that needs to be done by the sovereign in order to address the I'll call it the global situation or the more pandemic situation, which goes beyond dealing with the resolution of a single institution. And I mean, to some extent, you saw the difficult balance that this entails with what happened a few years ago to the deposit withdrawals at Silicon Valley Bank, which, interestingly, was credit-wise, what it had on its books had really, compared to most other depository institutions, good, solid assets that were either sovereign-related or from a government-sponsored enterprise, or even for the type of loans that were for particularly, I'll call it venture capital or new company type loans. They were well underwritten and were likely not to suffer a loss of principal. But what happened is that there was a rapid increase in interest rates, which caused these instruments to lose their value as a result of a rapid increase in the interest rate environment, which, once again, becomes not isolated to that bank, but is occurring across the board in financial services. And as a result, it, meaning Silicon Valley Bank, became book insolvent with respect to if you were to recast its books as to what the value would be in a market sense, then it would not have been able to satisfy all the liabilities it had. And that caused a run. And actually that was, what's interesting is that in its financial reports at the end of the prior year before it failed, it was all there in black and white. It was there for everybody to see that if the assets had been, as I say, marked to market, the institution would no longer be a solvent. As a result, when that type of environment hits, it becomes difficult for a policymaker to say, all right, well, should we just deal with this in isolation, or do we need to look at a solution that applies or could be applied to other financial institutions as well? And that's when you start using the term bailout, because there are either provisions associated with the infusion of capital or liquidity, or they can take a number of permutations.
When the first bank goes, how do you know whether it's idiosyncratic or systemic?
Well, it's why it goes, right? First, you can always point to, well, it wasn't managed properly, because if in fact manage interest rate risk appropriately, then it wouldn't be the first one to go. But or if it's managed its liability such it wasn't so dependent on a certain type of liability that had the ability to flee in the event of stress.
There are going to be a number of banks in that kind of situation. I mean, so most then would, under that way of looking at it, would, I guess, be systemic situations like you were describing. But should the first one be bailed out or not? Because in the Washington Mutual case, we said we're not going to do it, but if there is contagion, then we will do it.
Yeah, and so it becomes a question as to whether or not the risk of that first one failing is going to cause stress beyond the contagion effect in the system, and that's the stress would be due to the losses that other entities might take as a result of that first bank's failure. That there could be losses as a result of that particular bank's demise, or it could just be a contagion effect, which is kind of what we saw with the Silicon Valley Bank situation and what happened with Signature, although Signature Bank has some additional problems, and First Republic, they had some additional problems as well. But I mean, it was sort of a contagion effect of, well, these institutions have uninsured deposits. Uninsured deposits aren't a stable liability. And as a result, they may run into funding issues, and they might not be viable.
Jim, we didn't have a chance to get into it, and it's a shame we didn't get into it, because you really, to me, were the key person in developing a solution to too big to fail, at least in the United States, by what's called in our circles single point of entry, but basically saying that a very large bank needs convertible debt of enough quantity to recapitalize a very large bank itself, because the largest systemic banks, you really can't shut them down. So we have a system now where you can sort of turn the light switch on and off and wipe out the old capital and convert the debt to new capital and change management and deal with the problems of the very largest banks. In the United States, as you know, that applies to the globally systemically important banks. It did not apply to these mid-sized banks like Silicon Valley Bank. Should it apply to those size banks? And if it did, would the solution for Silicon Valley have been very different?
Well, in my opinion, having a loss-absorbing cushion for any large, what you could call domestically important banks, is an attribute that regulators should impose on these domestically important banks, because of the risk of what happened with SVB, that the contagion effect will spread. And not only did it spread domestically, it actually spread internationally, because ultimately depositors at Credit Suisse felt that given all of its problems, it as a bank was no longer viable, and it started to suffer a deposit run, even though it wasn't a U.S. bank. And if the depositors at Silicon Valley had been fully protected on the initial transaction, which, as you know, and this gets to be a little complicated here, but the transaction that FDIC approved after the liquidity run, which also happened to be a Thursday, that transaction was not one that guaranteed all deposits. It only guaranteed the insured deposits at Silicon Valley. And as a result of that, the contagion effect spread to the other institutions, even though, and this goes back to the point I made earlier, the rest of the banking industry was credit-wise healthy. The credit books on Silicon Valley Bank were not really distressed. This is the classic case of a contagion effect then spreading throughout the financial system. And a problem presented itself over the next 48 hours. The FDIC realized, as well as I think that the Fed and the Treasury Department, that another transaction had to take place, which ultimately would allow all the depositors to be made whole in order to stem the contagion effect of the uninsured depositors taking losses at Silicon Valley, and the perception that any other institution that had a high level of uninsured deposits may suffer a liquidity run and fail as well. And the FDIC had to basically change the type of transaction that it initially had started. And part of that was also due to timing. I mean, the liquidity failure at Silicon Valley Bank happened so fast that the FDIC, wasn't able to do its customary actions that it would take. I mean, excluding, putting aside finding a buyer, which it would need more time for, but to create something that's called a bridge bank that really didn't even have the data and time to do a thorough analysis on that, much less assume whether or not the bridge bank would absorb all deposits or just the insured deposits of the failing bank.
What happened in Silicon Valley, as you're describing about the run being so fast, we've talked about in earlier podcasts how with social media and technology improvements, things just happen faster and faster. So this kind of thing can only get worse in terms of the speed it takes. What should we all be thinking about in terms of preparing ourselves for what's coming next, whatever that is?
Well, just two observations somebody's been doing, dealing with failing banks for so many years. One is that to the extent that we know the problem, meaning the regulatory community is pretty good at addressing problems it knows. What it isn't too good at is addressing problems it doesn't know about. And obviously the historical liquidity run was one in which the wire rooms would be wiring money out. You take Connell, Illinois, back in 1984, the run that occurred there. And you can sort of see these runs, Penn Square, you can sort of see the snowballing effect that we observed at Washington Mutual. They take time, and you could sort of, at least in terms of days instead of hours, to manifest. But it's the problems that we don't know. And unfortunately, right now, there are new financial technologies that are being developed that are literally just getting seeded into the overall financial system. And we obviously don't have a lot of knowledge about those. We don't have a lot of experience about them. We really haven't given much thought as to what can go wrong. And we are not certain of the interconnectedness with the financial system of some of these new technologies. So it's that we have to worry about. But I'll tell you, I'm not sure there's an easy way to address it, only because it takes experience and time to learn about them and to discover where the gaps and weaknesses are. And to the extent that we discover the meaning the regulatory community discovers those and is aware of them, I think they do a pretty good job of trying to address them beforehand. I mean, there's certain resistance and it's not perfect, but generally pretty good. But it's typically the unknown that comes back to basically bite the regulators.
Jim, thank you for being here today. In the last several episodes of Banking Bad, we have begun to explore the challenges and complexities involved in handling large bank insolvencies. We have heard how destructive large bank failures can be and how quickly contagion can spread to other similarly situated institutions. particularly if uninsured depositors suddenly feel at risk. The typical government response is to bail out such banks at the deposit insurers' or taxpayers' expense. Financial crises can be controlled when the government protects all creditors in failing institutions, but it is expensive and erodes any market discipline that may exist to control excessive risk-taking, making future crises more likely. However, as discussed in the previous episode of Banking Bad, which focused on the failure and resolution of Washington Mutual, we saw that the failure and resolution of a large failing bank doesn't always have to require a government bailout. The failure of that $300 billion bank did not cost the FDIC anything. And because the uninsured depositors at WAMU also did not lose any money, uninsured depositors at other similarly situated banks did not panic and create problems elsewhere. These were significant positive developments. In today's discussion, we focused on an even larger failing bank, Wachovia, where we encountered two different problems. First, while Wachovia as a standalone entity may or may not have been too big to fail, its web of complex financial interconnections with other large financial institutions clearly meant it was too interconnected to fail. Fortunately, Wells Fargo stepped forward and Wachovia did not require a government bailout. But as you heard, it almost did. The second problem was that even though Wachovia's uninsured depositors did not panic, bondholders did, since they, along with shareholders, were the ones that absorbed the costs associated with Washington Mutual's failure. Without trying to minimize its significance, this clearly is a second-order problem, since unlike with uninsured depositors, bondholders cannot run at a moment's notice. They can only withdraw their money at the bond's maturity date. However, as we heard, funding for new bonds did dry up, requiring that the situation be addressed at Wachovia on short notice. We will address these issues further in future episodes of Banking Bad. So please join us for our next episode when we continue our discussions on past financial crises, the lessons learned, and how to best prepare ourselves for future crises.